Hello everyone and welcome to the Quantpedia Explains Trading Strategies video series. Today we will discuss using inflation to trade gold and US Treasuries.
Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today we will discuss one macroeconomic predictor that is known by everybody, even by you, and can be used very well to predict prices of the gold and treasury bonds, and we can build nice systematic trading strategy by using this predictor. So the question is, what's the predictor that I'm talking about? And it's inflation. Yeah, everybody is looking at inflation, everybody is interested in inflation because inflation is how much things you can buy for the amount of the money you have, and I mean, if you can buy the less things, then of course the inflation is higher. So the central banks like to have the inflation that's stable. I mean, it's not good to have a zero inflation or negative inflation, which is deflation, but it's also not good to have inflation which is 20%. So the central banks prefer to have a deflation around 2%, and they really do not like when the inflation is accelerating or when it's very fastly accelerating. So what does it mean? We can use this knowledge about the rate of the change of the inflation, and we can use it as a predictor, and we can time gold and treasury bonds by using this predictor. The reason for that is because when we have a period of very fast and accelerating inflation or high inflation, it's better to hold the gold. On the other hand, when you have a deflation or the inflation decelerate a lot, that's better to hold treasuries in this case. Let's get to our article. The article is on our blog. As I mentioned before, our observation is that the absolute level of inflation doesn't significantly impact the economy and the central bank's decisions. Rather is the change in inflation, so rate of the change, increase or decrease. For example, if the Federal Reserve has a target 2%, then consider the following scenario. So month-over-month inflation for May is 0.2, for June is 0.4, for July 0.8, and for August is 1.6. So what in this scenario shows is that we have an acceleration of inflation, which is really problematic. So I mean, the inflation is not stable, but is going up, and the prices are going fast up and faster and faster. So in such cases, the central bank or Federal Exchange is compelled to respond, and it's typically through the rising interest rates. And when they rise interest rates, it's very bad for a fixed income, but it's good for the gold on the other hand because it can work as an inflation hedge. So this is the observation that is the basis for our investment strategy. How does it look like? So we run an analysis from 1981 to November 2024. Why we picked this period? The reason for that is because that was the time when we had a very strong bull market in bonds. And if we are able to find a trading strategy that outperforms the bonds or treasuries as a benchmark, we know that the trading strategy is a good one, because I mean, it's very hard to find a strategy that outperforms fixed income or treasuries in this 40-year bull market. So this is our data. So we download data for gold, for 7 to 10 year treasury bonds, 20 plus year treasury bonds, short-term treasury bonds, and US dollar index. And then we had to find the data for inflation. Now the problem with the data for inflation is that when you try just to download the data from FRED, from Federal Reserve Bank of St. Louis, I mean, very easy, but the problem is that those data are not point in time because they have been recalculated a lot of the time, and they are not the data as they have been reported. So for this reason, we went direct to the source, to US Bureau of Labor Statistics, and we downloaded all the files with the actual reported inflation. Well, I will show you how you can find this data. Here is the link. So here are all the data, so link will be in the description. So here we can find the data, but let's get back to our trading strategy. The first thing we did is simple analysis. So we ran analysis and we compared the performance of the underlying assets during the whole 40-year period. So as we can see, the best Kalmar ratio and best Sharpe ratio, I'm not talking about the cash because 2-year bonds are like the cash, but from the risky assets, the best Sharpe ratio and Kalmar ratio is realized with the 7 to 10 year treasuries. So we have 6.6% performance, Sharpe ratio 0.9, Kalmar ratio 0.29. I mean, it's very hard to beat this performance. Yeah, you can have a nice, better Sharpe ratio, better Kalmar ratio, but with lower performance because you can hold the cash. But if you want to have some performance higher than the cash, it's very hard to have a better performance than the 7 to 10 year treasuries. What is the impact of inflation? So we use the inflation predictor and we use the inflation data, and we divided the whole sample into two parts: the regime in which the inflation is going down and the regime in which inflation is going up. And how we did it? So let's imagine that once again we have a example. So the reported inflation for January 0.3, February 0.3, March 0.4, April 0.5, and May 0.5. This is month over month. The change between February and January is 0, between February and March is 0.1, because here we have a higher increase in the rate of the inflation. Between March and April is 0.1, and between April and May is 0. In our theory, it's not the high monthly inflation, but the change in inflation is what is the significantly more dangerous. So when the rate of the change of inflation is positive. So the high January and February inflation, 0.3 month over month or 3.6% annualized, is unpleasant, but it doesn't require Fed's attention. So what is risky is if inflation accelerates. So the March is 0.4, April is 0.5. So we have accelerating inflation. This acceleration inflation will probably cause the Fed to jump into action, and this is why we use 2 successive monthly accelerations as a trigger for our regime change in our model. Of course, the data for inflation are delayed, so we know the April's inflation at the end of the May. So that's when the trigger is launched. So it means at the end of the May, we know the April inflation, we know the March inflation, we know the February inflation, we know that we have 2 successive months of the accelerating inflation, and that's the date at the end of May when we select our regime and our regime change to inflation up. We are using the same calculation for the inflation down, but just with the opposite sign of the calculation. If there is a January 0.3, February 0.3, March is 0.2, April 0.1, then at the end of the April we change our regime to inflation down. This is how we can divide the whole 40-year cycle into inflation down regimes and inflation up regimes. And now let's take a look on the numbers. So here we have inflation down regime, and we can see that it's very, very good for treasury bonds, especially ETF, which is 7 to 10 year treasury bonds, has nice performance, nice Sharpe ratio, nice Kalman ratio, and also the 20 plus years bonds, they have nice performance, nice Sharpe ratio, nice Kalman ratio. On the other hand, when we have the inflation up, this is the horrible time for holding the bonds, but it's great time to hold the gold. We can see that the practitioners are right, so the people who think that the gold can work as an inflation hedge and the inflation is bad for treasury bonds, all of that are right, and we can use that acceleration of inflation to divide the whole period into inflation up and inflation down regime. But that's not the end. We have one more improvement that can be suggested, and that's inclusion of the momentum. What is the added value? So the addition of the momentum filter, we use 12-month momentum, should increase the quality of the signal. So if we are in the inflation down regime and the momentum signal of the treasury bonds already have a positive performance, then the overall risk return ratio of the asset should be higher, and also the same should work for inflation up regime and the assets that are most sensitive to it. So for example, for the gold, so when we are in inflation up regime, the gold price is already going up, so the momentum is positive. This should be like the best time to hold the gold, and that's the truth. So here we have the inflation up regime trend up, and we can see that the gold has a little lower performance, but better Sharpe ratio, better Kalman ratio, etc. So what we can do is that we can build now the final model trading strategy. So we have the 2 possibilities. So we will buy the bonds when the inflation goes down and the momentum for bonds is a positive. We will buy the gold if inflation goes up and the momentum is positive for the gold. In the cases that none of these 2 is true, we are holding the cash. So, and we can compare the performance of this strategy to its natural benchmark. The natural benchmark is the equally weighted portfolio of US Treasury bonds ETF and the gold ETF. And here we have a comparison. So the benchmark performance, Sharpe ratio 0.65, max drawdown minus 20%, Kalman ratio 0.27, and our model has a significantly better performance, better volatility, better Sharpe ratio, lower maximum drawdown, better Kalman ratio. The model, simple model based on inflation, clearly outperforms the benchmark. It outperforms also all of the individual ETFs that we have in our investment universe. So our conclusion is that we can use the inflation very nicely as a predictor, and we can build the market timing strategy out of that. What is the market timing strategy? And at the end I'm asking this question. So the market timing strategy is a strategy that tries to enter and exit the market in the right time. So you are not trying to pick the best asset in the market, so you are not trying to pick the best equities or the best bonds from the fixed income market, but you are trying to enter and exit the market. So you are trying to enter the fixed income market when it's positive for you, and you exit the market when it's not positive for you, and you enter the gold market when there are positive times, and you exit the gold market when it's not the time to hold the gold. So that's the market timing strategy. We have a lot of them in our database, over 200. So this is one of them. Feel free to go through our article if you like it. In case you like it, give us a like, drop a comment, follow us on our social media channels, and I hope that you will join me in the next video.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.